Hi, I'm Jurrien Timmer, and I'm the Director of Global Macro at Fidelity. And welcome to the third quarter edition of Timmer Time. So elections affect the market, of course. We tend to view it as policy over politics. And obviously, whoever, depending on which party wins, whether it's left or right, which person wins, whether in the US at least, the House and Senate are controlled by the same party that is in the White House. We call that a sweep. The version of that would be gridlock, which is, we're kind of in a form of gridlock right now. So all of those things matter in terms of what kind of policies get enacted, right? On taxes, on regulation, you think about the energy transition and other parts, geopolitics, international trade. And so obviously elections do matter, and the markets already are wrangling with, who might win, what does it mean for this and that. But ultimately, for long-term investors who can ride out a full election cycle, which in the US is 4 years, the elections don't really matter that much, right? If you look at the markets 2 years out after an election, there's a pretty big dispersion between outcomes of, who's in the White House, is the House and Senate, the Congress, controlled by the same party. That has an impact on the markets over 2 years. But in the US at least, we have this thing called the midterm elections, which are very important, and they happen after 2 years because they tend to course correct if there is an outcome in the presidential election that might be too much to one side or another. And so if you wait 4 years, there's almost no difference whatsoever in terms of what happens to the market based on the outcome in an election. So for long-term investors, it doesn't really matter, but over the next couple of years, obviously, there will be impacts. So the markets have been broadening lately, which is a really good thing to see because healthy bull markets tend to have a lot of participation. And of course, the market over the last, so many months has been relatively narrow, at least on a relative basis, meaning that while plenty of stocks are participating in the bull market that's now been underway for 21 months, only a handful of stocks have been leading it in terms of relative performance. And in recent weeks, that has now started to broaden in no small part because the inflation data are now giving the Fed a license to start cutting rates. And so that breadth that we've been looking for is happening again, and it's a good thing. So bonds are such an interesting asset class, right? So in the years up to the pandemic, when yields were very low and real yields were negative in some cases, bonds really were an expensive insurance policy, right? You had to kind of hold your nose a little bit to buy them because you were not getting that real positive yield. But you had this sense that if the stock market went down, bonds would protect you because the correlation between bonds and stocks was negative. Now we're kind of on the other side where the stock to bond correlation is now positive, and we don't know if it's going to stay that way, but my guess is that it will. But now bonds offer value, right? The yields are between 4 and 5%. The real yield is around 1.5%, even 2% in some cases. And so bonds have become a viable asset class on their own, even if they don't any longer play that role of diversifier in a sort of 60-40 portfolio. So there is definitely a place for bonds, but you just have to be aware of what role it is that they play.